and use for your closing costs or down payment. We do that.
Okay, so if I was to, sell the house, say for instance, like I said, paid the 150, I sold it for 180, like it was worth 200. If someone agreed to buy it for the 180, would I have to go through the whole process of purchasing a home again, or can I buy a house if I buy one for 135? Can I pay this cash without having to deal with anything else, just get a realtor and pay cash from what I made from purchasing somebody buying the house from me?
Yeah, when you sell your house and whatever that sale price is, that's what you come in from the table with.
Mm-hmm.
Yeah, you can turn around and buy your house because you got your checking account. But you can't do nothing else with that house you're trying to sell to that buyer.
Oh, okay.
Well, if she sell it, but she won't get the whole 130. You don't only get what
What it appraised for.
What's left?
Whatever, yes.
That's what I want to do.
Yeah, I know that too, right?
Hello, can you hear me there?
Can.
Hello. Good evening.
I'm coming, Mr. Stewart.
Okay. Well, good evening, everybody. I can't see you guys, and I'm sorry I can't be there in person.
Okay, I'm downloading the PowerPoint now.
Certainly.
Let's see. Okay, Mr. Stewart.
I'm here.
All right, just let me know when you want me to click.
Awesome. I can't see the PowerPoint, but that's okay. We're going to make this work for you.
Wait, I probably, let me see what I done. Hi, exit.
So if you were to share screen, then it should work.
Okay, I know how to do this.
It's just technology, but that's okay. We're going to work through it and give your people just what they need. Yay, I can see it.
Okay. I'll begin. Okay, do I need to make it bigger? Oh,
as long as they can see it, I'm good.
All right.
Well, awesome. Can you guys hear me?
Yes.
Awesome. Well, first I want to thank you guys. Ms. Walker, I want to thank you for inviting me to share with everybody there today. And I want to thank everybody for coming out today. It's an honor and a privilege to come before you and share with you what it takes to get to, maybe for some, the next level in life, for others, a new place in life, and just for others, just a change. So I'm glad to be able to share with you. I've been doing this for about 20 years. I've been in finance for about 30 years. So I welcome any questions. I'm going to take you through a brief overview with the PowerPoint that we prepared, just to give you an idea of what it takes. And then at the end, if you have specific questions, then I'll stay around for questions and answers. So again, I apologize that I can't be there, but I think it's better to be safe than to make everybody there sick. What do y'all say?
Yes.
Awesome. Well, the first slide you see it. We're going to talk about your home loan basics today. Would you please advance the slide? Okay. Are you on the next slide there? Yes, I see it coming. Slide number 2. Slide number 2. Perfect.
Okay. Why I just can't click?
It's just delayed.
That's 2?
That is correct.
Okay.
Slide number 2 should read working with a local independent mortgage broker. Working with an independent local mortgage broker. So for the sake of lack of technology, what I will do a presentation. If we can't get this to work, I'll just explain some things to you as we go. So the next slide should have read working with a local independent mortgage broker. One of the things that you should consider when working with a mortgage broker, the mortgage broker is actually your advocate and they're working on your behalf. So unlike when you go to a bank, whatever documentation the bank sees, the bank has to hold on to that documentation and use it as a consideration for your loan. With a mortgage broker, if you bring me documentation and the documentation won't work, I have at my discretion to tell you what documentation will work. I do not have to submit the documentation you bring to me to the underwriter or to the bank. The reason I can do that is I work with mortgage brokers work with multiple lenders. So I might know that a tax return will work at one lender, yet it won't work at the next lender. Or I may know that bank statements may work one place, yet not at another. Each lender that I work with, they have different criteria they use to determine who they want to loan to. So that's one of the main reasons to work with a broker, especially if you have challenging situations such as self-employed or credit challenges, or even employment history challenges. So either of those challenges, you want to go see a mortgage broker. He can tell you he can direct you. However, the bank, they only go by the information they have on hand. I'm moving on to slide 3 now. The thing that gets you in the door that will allow you to buy the home is your credit score. If your credit score is not up to par, then the process won't even start. I don't do credit. However, I think you have a great person right before you that can help you with your credit. There are some considerations that we use for credit though, because it's not all about the credit score. So sometimes you can apply for a house and have a fairly high credit score, yet you won't qualify for the home. So would you advance to the next slide, please? The main thing for credit score that gets you in the door is the score itself, the credit score itself. For most lenders that is not operating in the mainstream, the credit score would be 580. However, we do look at some things in addition to just credit score. We look at your FICO score range. That's what the credit score will have. And we kind of look to see, okay, some are high, some are low. Why is it that way? We look at the number of accounts on your record, because if you started opening a bunch of new accounts, then that makes your loan a lot more risky. We look at your recent lates or delinquencies. So typically people have patterns. Every so many years, something happens. Like every 3 or 4 years, they'll start getting into another credit challenge situation. Or also look on the good side of that to say, oh, this person's been working with Ms. Walker. They're cleaning up their credit. They're in a better position. So this is somebody that I believe I can make a case to lend money to, because they were in a bad place, but I can see based on their recent 3-month, 6-month, 9-month history, they're changing. They're making some major changes in their lifestyle and their purchasing decisions. We also look for new credit and also credit inquiries. Credit inquiries can hurt your credit score depending on the type of credit inquiry you have. And those are all things that Ms. Walker can discuss with you. But those are some, in addition to just credit score, some things we look at to make a lending decision. Would you advance the slide, please? There are actually 4 parts to buying a loan. The first one is credit. The second part is your income. So you have to have good credit or good enough credit, and you have to have income. Those 2 parts are the main 2 parts. When we look at income, we look at something called, we look at your employment history. So what we want you to have is 2 years of employment. And when I put the first 2 years of employment, that's more with reference to W-2. So there's been a saying that says, if you have to work in the same field for 2 years, well, that doesn't make much sense because you may be working in one field, you find a better job that pays more money. It would be a penalty to you to not take the other job because you hadn't been working in the same field for 2 years. So once you have been working for 2 years, if you're advancing, then we consider that employment. The next is college, counts as employment history. So you could go to school for, I don't know, you go to process tech school, you get out, you've been going to school for 2 years, you automatically qualify to buy a house, as long as you have a job in that field in which you graduated in. The next thing that we're gonna focus on later in the conversation would be self-employed. You have to be self-employed for 2 years to qualify. First, they count 2 years as enough time to verify or validate that your business will be successful. Would you advance the slide, please? Now, along with employment history is income. So his employment history and income is pretty much are the 2 that ride together. Salary or commission. And the reason I put that, some people just get straight salary, some get salary, commission, bonus. But what we count is if you're getting a commission for 2 years or a bonus for 2 years, or even overtime counts, but only if you've been getting it for 2 years. So some people, they'll get a different job that that now pays overtime, but the previous job didn't. And it seems unfair that that they aren't able to use the overtime. But overtime and commission has to be proven over a 2-year period. We also consider whether you're full-time or part-time. And yes, someone working part-time can buy a house. As long as they're making enough money, they can buy a house. So we don't care about the number of hours you work. We care about how much income you earn. And I want you to think about that in terms of like some nurses, they only work the weekend shift. Well, technically that's 35 or 36 hours or 30 hours, but they make enough money to qualify to buy a house, and that's perfectly fine. Another way we calculate income is strictly based on your last 2 years of tax returns. And with those tax returns, we look at what you counted as your profit, your bottom line take-home profit. It can get a little confusing with self-employed because they may bring in a large number of money, but they'll deduct so much from there till the bottom line profit looks like it's very little or none, or negative in some cases. And the last one, I think that's where I kind of caught the last of Ms. Walker when she was saying keeping good books. So if you don't keep good books, then it won't work for you. The last program we have is bank statements program. We have a program that if you're self-employed, you can use your bank statements without even using your tax returns or W-2s or 1099s or anything. Your bank statements will qualify. So what we'll count is half the money going into your bank statements, half the deposits that you make, we count. So there are many ways to prove your income. However, when you think of income, you want to think of what's on paper and can be proven. If you think about, and when you're thinking about income and doing loans, the more you can prove, the better loan you get and the lower interest rate you can get. You would just like to think, if you think of it this way, if someone can prove they're making money and versus someone who can barely prove they're making money, who would you want to give the better loan and the better loan and the better interest rate to? The one who's more stable and that can prove it. So don't get confused with self-employed. Self-employed can get just as good, but you have to be willing to put the numbers, to put the money on paper. Would you advance, please? Hang on here. Are you on slide 7?
Yes.
Okay, great. Is that the one that says income there?
It says debts and deductions from your pay.
Perfect. Thank you very much. So the other thing that we consider not only the income, but debts. So child support can hurt you or help you. If you're paying child support, then we need to have proof that you're paying it and how much that amount, the required amount. There's been a big challenge with child support if you're in arrearage. Well, pretty much whenever you get on child support, if it gets to your credit, it's going to show arrearage. We don't care so much about arrearage. All that we care about is that you're paying it. And sometimes you may have a $500 a month child support with an extra $100 going to arrearage. That is perfectly fine as long as you are working toward paying off your debt. What are considered debts? Whatever's on your credit report, that's all we count as debts. Garnishments. We look at your check stub to see if there's any garnishments. Leased versus owned vehicles. Vehicles that's leased, we don't count them when it gets to the last few payments. But if you own them, then we certainly count them, own them, and they're on your credit. And then student loans. If you have a student loan, it's counted multiple ways. But right now, since Corona, it's been very favorable for people with student loans because most of the people on income-driven repayment plans, and that allows them to buy the house without having to calculate a normal student loan payment. Would you advance, please? I do want to revert back to that last slide. One thing though, with child support, you can count it as income as long as you've been getting it for at least 6 months with some programs and 12 months with others, and it's court ordered. Now, that should be slide number 8, and it's assets. What is considered assets? Money that's in the bank that's been there for 30 days or more. That's considered an asset. Or 401k is considered your asset. Gift funds. If it's been proven and the money has been in the person who's giving you the gift for 30 days, that counts as assets. Even insurance policies that has a cash value, they're counted as assets. So cash money is not considered assets. I know in the Ascension Parish area, in Assumption Parish, a lot of people don't like using banks. So they keep their cash and until it's time to buy a house, and sometimes it can be quite challenging. But there are ways to work the cash into the bank, and your mortgage broker should be able to show you how to do that. And next slide, please. The next slide has to do with loan programs. So I should have gone over the slides that have gone over. They should have included your credit, your income, your assets, and I believe the realtor there, or your realtor, whatever realtor you're using, or however you do that, that realtor will handle the home itself. And I know Ms. Walker, she only connects herself with the best people. So I'm assuming if there's a realtor there, she's the best.
Ms. Boyette. Sandra Boyette.
Oh, yes, with Sandra. Yes. I just been not feeling so well, so I'm a little bit loopy, but I hope y'all can understand me. Can you understand me?
Yeah.
Yes.
Awesome. All right. So this last one talks about loan programs. There are loan programs. One of the programs called conventional. there's different programs, different credit scores, different requirements, it's like different entities or different agencies are loaning money, or they're backing up the money that's being loaned to you. So they go by different rules. And for lack of, I don't want to confuse you with all that, but I do want to at least tell you this. Conventional requires a higher credit score. FHA is one that requires a less credit score. USDA, middle of the road. VA, lower credit score, but for veterans. So conventional, you need anywhere from 3% to 5% down payment. FHA, 3.5% down payment. USDA, no down payment. And VA, no down payment as well. A couple of other differences: conventional, you can buy the house anywhere. FHA, you can buy the house anywhere as well. USDA, there are designated areas for where you buy the house, and VA, you can buy the house anywhere as well. So there's some differences, and I'm sure that when you connect with your mortgage professional, they'll be able to share the differences to see what you're best qualified for. Remember we talked about debt ratios and assets and all that stuff. These different programs, they all have intricate parts about their view or their opinion of what assets are. They have different views about how much your debt ratios can be, what's considered debt, what's considered student loan debt. So that's why sometimes you can see one person can get a loan, but it looks like the next person right next to him can't get a loan. It's because the little intricacy in the loan program that makes a difference. So I just wanted to give you a little bit of an overview. And this PowerPoint is available. You can give it to whoever you like to give it to, Ms. Walker. And also, I'm available for questions. My main reason for being here is to support Ms. Walker, because I know that you have somebody who's willing to work with you and work for you with diligence and with professionalism. So any questions as we go forward?
I have a question. I have this question because some people may be actually going through this. Can you explain the process when it comes to qualifying a home when someone has filed for bankruptcy?
Yes. There are multiple types of bankruptcies. The ones that we mostly work with are Chapter 7 and Chapter 13. A Chapter 7 bankruptcy is the one where you give everything back. That bankruptcy has a longer restorative program. For instance, you have to wait longer with that bankruptcy. It's a 2-year or 4-year program, depending on the loan program you select. Another bankruptcy is a Chapter 13. As long as you're paying on time, then you can pretty much get out of Chapter 13 at any point. Chapter 13 is the one where you have to pay a certain amount back every month. You have to go to your trustee, the person you make your payments to, the judge have to agree to it, that type of stuff. But yes, you can buy a house with if you've been bankrupt. Some programs 2 years, some programs 4 years, VA 1 year. Did that answer your question?
Yes. Anybody else have a question?
Could you go over the down payment, whether it was no down payment or it required a down payment for the loan programs again, the conventional, the FHA?
Yes. I think you're still in the loan program screen. Am I correct?
Oh no, I'm on questions. Do you need me to go back?
Yeah, go back to that screen. I think it's slide number 9. So conventional, they want the high. You have to have the excuse me. You have to have the highest credit score. The down payment is 3% of the purchase price or 5% of the purchase price. It depends on, and then under conventional, there's still differences in the loan program. So the short way of saying between 3 and 5% down payment. FHA is 3.5% of the price of the selling price or the purchase price of the house you're buying. So for instance, if you buy a house that's 100,000, it's 100,000, 3.5% down payment, that would be $3,500. You have, that's required to bring to the table. USDA is 0, you have to bring to the table, and the VA as well. But I do want to take this moment to explain a couple of things. There's 2 parts, and if you're taking notes, it may be a good place to take notes now. There's down payment, which is the reduction of the sales price for the product you're buying or for the house you're buying, the reduction to the sales price. So for instance, you buy a $100,000 house, the down payment is $5,000, you only owe $95,000. However, there's closing costs. Closing costs is separate and apart and totally different from down payment. The closing costs is what's used to pay your insurance upfront, your taxes, it pays the title company, it pays title insurance, and it's a host of other fees that closing costs that will be charged on your loan. Typically, and I'm sure your realtor, Ms. Sandra, correct?
Right.
She will be able to explain this more to you, but in the general market, we usually ask the seller to pay the closing costs. If not, when you buy a house, you'd have to pay the down payment and roughly 3% of the selling price for closing costs as well. Let me give you some numbers to make this make sense. Conventional loan, you have to put 5% down. You're buying a $100,000 house. That means automatically you're required to put $5,000. However, there's closing costs. You have to pay yourself. Let's say the seller's not paying them for whatever reason. That would be an additional $3,000. That means you need to bring $8,000 to the table. So I wanted to take the time to distinguish down payment from closing costs. However, there are many programs out right now. There's CAFA programs, which will help you with down payment or may pay it all. There are FHA programs. They're willing to, they pay the whole closing costs and all or some of the down payment. So you have to see your particular situation and where you qualify, because you may be able to get into a house with very little or no money. Now, those programs are also dependent upon things like how much money you make. Are you a first-time home buyer? So your mortgage broker is the one who'll help you decipher what programs you best qualify for. Some of those programs are also credit score driven. You have to have a 640 credit score or a 620 credit score for some of those programs. So I don't want anyone to leave confused. What I would like you to do is talk to your credit professional about credit and tax. I know Ms. Walker does taxes in your tax circumstance. Talk to your realtor about what programs you might qualify for, and she will be able to connect you with the mortgage lender who would be able to discuss that with you more. The reason I say that, although I'm here representing a mortgage company, that we actually own a mortgage company, I always believe you have family, you have friends. Ms. Sandra may have somebody she works with. I respect people, who they work with and how they work. So I'm not trying to say you have to come to me. I would like you to come to me, but you do not have to come to me. My most important thing is that you get what God has for you. Did I answer your question?
Just to expound on the type of loans that you were talking about, you said something about different loans. I think you said CAP or what was that first one you said?
One of the people, it's CAFA, C-A-F-A, and it's Capital Area Finance Authority. So the The 4 names I gave you on loan programs that's on the screen, those are the different types of loans. But there are organizations like CAFA. It's another one, Mid-City Redevelopment. So these different programs or organizations come in and they help facilitate the home buying process for people. So it's only those 4 loan programs that I told you, but it's people who are organizations that try to redevelop a certain area or try to help first-time home buyers. So they come in and offer other things on top of that program. Some of them are restricted to certain areas. Some of them are restricted to certain income ranges, some to certain credit scores. But that's why buying a house, you may have someone tell you, oh, I did this, I did that. And they may not really know what they're talking about, only because there's so many variables. So don't be discouraged or even encouraged in some cases because someone says they bought a house and they did this or that. You have to take the time, put the work in, and figure out where you can qualify. Did that help you?
Yeah, thank you.
Any other questions?
Well, actually, I do have another question, and it actually goes back to what you just said. So I'm assuming, and correct me if I'm wrong, with these different ones that you say, you will look within your area that you live in, and each area might have a different program? Is that pretty much how that is? For example,
go ahead.
For example, like, let's just say if you're in Baton Rouge, and I do think I've heard Baton Rouge have that mid-city redevelopment. Well, let's just say I'm in an area outside of Baton Rouge, and I know the rural areas have the USDA, but within my city, they may have a different type of loan program other than these. So each city will have different programs.
Let me give you an example, okay? There's state programs, there's federal programs, there's local city programs, but I do want you to be careful to be sure you put in the homework with a mortgage professional. Let's say, for instance, like you just said, USDA is a rural program. Well, over Gardia area, that's from rural development. Over by Southern University in the airport area, some of those houses are rural development. In central Baton Rouge, near where Costco is, that's some of those properties are rural development. So that's why you have to have the right person. The right information will get you the right process. So you want to talk to a professional about it. The one thing that's frustrating as a mortgage professional is when the customer comes in and they don't have the right information, they have all these misconceptions about what all these programs do. So I applaud everyone who's at this seminar that you're getting the education and the right information, that you're not just going to beat yourself up, your head against the wall with wrong thinking and wrong information to get frustrated. So I do applaud everyone there, and I'm so glad that you took the time to come out to get what you need so you can get what you want.
I have a question.
Yes.
As far as you having that knowledge, when you're trying to purchase a home, is it more for your realtor to let you know what programs qualify for that area? Is it something that's in their system where they would know it? Because I'm not sure if when we're looking at houses online that it would show the programs that's offered for that area. So do we talk mainly to our realtor to teach us and kind of help us more with that? Is that how that works?
I would say when you're online, they're trying to attract you to the house, so you might not have all the information. The whole goal is to hook you on the house. That's the purpose of online. Your realtor's purpose is to find the right house for you. So I always say the realtor is always the best resource because she has, and she can answer for herself, but the realtors I work with mostly, they have information. I mean, you're looking online, there's beautiful pictures, like if you're dating online and you see somebody and they look all a certain way online, but then you get there, it's like, wait a minute, this is not the same person. It worked that same way with the house.
Okay. Thank you.
And to just get a little bit more in depth with that, how would your realtor know? Once you're gonna get a pre-approval first. And with that pre-approval, you're gonna get a copy of your pre-approval. And if you wish to work with Mr. Stewart, he'll send it to your realtor or you can give it to your realtor. With that pre-approval, it's gonna have on there exactly what you'll qualify for, so she'll know where to look for a house at or what area you can and cannot go in, depending on that program, like the USDA, well, the Rural Development Law, because that is in certain areas.
So with the with the pre-approval, it's a time limit, right? It's 90 days?
What's the time limit for the pre-approval?
Typically it's 90 days, because your credit is good for 90 days. So after 90 days, you have to re-pull credit. So as long as your credit good and you're still doing what you did, the pre-approval is good. Just know that if your credit change, it could change within 90 days. We need a new credit report. So I do want to mention this. When you sit with your mortgage professional, they should tell you the different types of loans you qualify for. You should be able to work out, hey, you need this much money. This is what's available to you. Even if you're with the right mortgage professional, they should be able to say, you have to get this, this, and this fixed. Go see Ms. Walker so she can get these things fixed before you go to the realtor, because the realtor really can't do anything if she didn't have the pre-approval. So it's kind of an order to it. It's realtor, then realtor sends you to mortgage broker, then mortgage broker sends you to realtor/credit person, and then you go back to the realtor. It's kind of a process. A lot of people go to the realtor as if the realtor can do something, but especially in this market, if you don't have a pre-approval and COVID and houses going off the market so quick, no one's going to want to show you a house. So you have to follow the process so you can be in the best position to buy.
Okay, is it true that in the process of buying, I guess once you're in your contract, that you have to limit yourself on your spending, such as like not using your credit to purchase furniture, or like just to not go out just splurging all over, just spending money? Is it true that you need to kind of watch what you're doing until you're finished with your closing?
Well, what you don't want to do is increase your debt. When you come to me, I make a decision based on the debt that I have before me. So if you start increasing your debt, that means you're more risk. So they typically, about 1 out of every 3 people, they may pull your credit at the end. But we do have a system that tells if anyone else pulls your credit. So if you started with me, right before you close, the system's going to alert us that you had your credit pulled, I don't know, at ABC Furniture Store.
And that will make your score go down?
Ma'am, it could take your score down. It could make your debts go too high and you no longer qualify. So the safest way to do it is in the middle of any big purchasing process, you want to keep everything as quiet and as calm as possible with way of spending. Are there any other questions? Can you hear me?
Yes. No one else has any other questions? So I don't think there's any more questions. This was a great presentation, and I thank you so much for joining us today.
Well, I thank all the people who took the time to come out, and happy shopping.
Bye-bye.
Bye-bye.
Okay, bye-bye. I clicked off. I don't know why this clicked off. I don't know why.
You're welcome.
Yeah. Oh, see. Okay, so I let everyone know that I was recording. It will not be released to the public. It's just for training purposes, so I could go back over see where I need to improve, or if Miss Sandra wants it, then she has it. Okay, that's fine. So we see everybody. So I'm gonna have to turn it. Well, I guess I could leave it like that because I like to look at myself speak sometimes because a lot of times I make hand gestures. Okay, so that was a really good presentation. I hope y'all took notes, and if y'all have any questions, y'all make sure y'all write it down. Y'all reach out to us. Next, who I want to introduce is Mr. John from State Farm. And y'all, let me tell you, I like personal relationships. And with personal relationships, I see how you work. I see what you can do for me, and then I can refer that person on to the next person. And he actually saving me $100 in car insurance for what? And one of my cars had liability, and when I made the switch, now I got full coverage on all of my cars. And I want to put some life insurance on one of my kids. So I have some great savings. He's very thorough, and not only that, he really do educate you. He will look over your other policies just to see what you have. And a lot of times they're giving us a bare minimum. They gave me a bare minimum, and he helped me get the maximum coverage. I got more bang for my buck, and I'm paying less. He's gonna talk a little bit about insurance. He's also gonna talk about homeowners insurance. And if you are already a homeowner and you're looking to sell your home, he will look over your declaration page for you. He will look over everything just to see what you have, what you don't have, to see if he can get you a better rate. So I'll turn the floor over now to Mr. John.
All right. Let's see here. I wrote down a few notes. Let me see if I can get through all this today. So mainly wanted to talk to you guys about homeowners insurance. Can y'all hear me okay? So, why have homeowners insurance? Obviously, it's your most valuable asset that you own. In most cases, the lender generally requires it because they want their interest in the property insured. If there's a fire or a pipe burst and the home is, drenched in water, obviously they want to make sure that their interest in that property, since they're giving a mortgage on it, is protected. And so they do require homeowners insurance on there. But it also protects you from liability. And especially in a state like we live in, if you're watching TV during, most hours of the day, you'll see the commercials for, any given attorney at any given time. And statistically in the U.S., 17% of accidents involve an attorney when that accident occurs. In Louisiana, anyone want to guess what that percentage is if the national average is 17%? 70%. And it's no reason, no guess why our rates are, the second highest in the nation, with a much lower average income. And so it's a big difference. I can't tell you how many times I've done a state-to-state transfer from someone from New York, which is a much higher income earning state, and they come here and they're like, "Good grief, y'all's insurance is double what I'm paying in New York." I moved to Mississippi at one point years ago, and I thought my insurance carrier had dropped some of my coverages because mine literally cut in half. And so, it is a lot based on location. But with your homeowner's insurance, the liability protection is the key factor. And one of the things that people don't think about with homeowner's insurance is that when you're in your car, you're covered with those liability limits. We call them split limits, whether it's 15, 30, 25, or 100, 300, 100. And if y'all have a question about that, I can explain that further. But when you're not in your car, your homeowners protects you. So let's say you're at Starbucks and somebody trips over your back. Your homeowner's liability actually protects you from that. Anyone have pets, dogs, like that? A lot of homeowners policies exclude pet liability. State Farm does not. Most of your top rated carriers will not, but some will exclude certain breeds, like Pit Bull or Rottweiler. So if you have any type of specific breed or any pets in general, you want to make sure you ask your homeowner's insurance company if they cover that. And if they don't, a lot of times they'll cover it with an endorsement. So a good example, I had a customer came to us. She said, John, do y'all cover pets? I said, yes. She's like, do you exclude any type of pets? I said, no. And she kept asking me this at least twice. And I finally asked her after pulling her insurance report, because we do see, like, when you make claims and everything, you have to use that for rating purposes. And I saw she had a $53,000 liability case 2 years ago. And she said, how much? I said, $53,000. She said, I knew that she had sued me, but whenever the insurance takes over, they take over everything. You don't have any involvement in it whatsoever. You can't go after that person after the fact. It's called subrogation. You're basically giving up everything to the insurance company so that they take care of it on your behalf. And so because it was subrogated, she never found out the end result of it. But what happened is her dog got out the door. The neighbor across the street was walking two of her dogs on a leash. That dog gave the other dogs chase. So the lady fell into the street because they were pulling her leash. But she sued the lady. So mind you, the dog never touched anybody, never bit anybody, never touched them. But she sued her for $53,000, and she found out that her homeowner's insurance did not cover it. But because homeowner's insurance covers you no matter where you are, this lady happened to have two homes. She had one in another area that was covered by another company, and that company actually insured her for that loss, even though it wasn't a property that they insured. So, so that's a good question. You had a question real quick?
Has it always been like that?
Has it always been like that as far as exclusions?
Yeah.
Or
No, where your homeowner covers.
yeah, when you're away from your home, yes. And generally most cases, now I don't know, there's some, now not all insurance companies are the same. And that's always stress with people, is because there are a lot of different insurance companies in Louisiana, and every policy is written differently. And so just because you have a certain amount of coverage with one company doesn't mean that you're going to get the same coverage with that other company. A good example is like hail hits. If you get a hail damage on a roof, State Farm is going to look at that roof a lot more liberally, a lot more in your favor than a company that's a different insurer. They may say, well, we need at least 20 hail hits per square, where State Farm may say 10. So the threshold for you to actually get that roof repaired is going to be a lot more generous with State Farm than some of your other companies out there. And so that's important, obviously. But yeah, you want to know if they exclude anything. Trampolines are often excluded, not with State Farm. Pool liability. So like if some kid gets over your fence and they want to jump on your trampoline and they break their neck, and your homeowners excludes it, then that's a big liability that you're self-insuring. And a lot of people don't know that. So it's important to find out, those kind of things with homeowners. Let's see here. Oh, another big factor, surplus versus admitted. So in insurance, a surplus lines is not covered by the Louisiana Guarantee Association. And what that means is that when you go with a surplus lines insurer, and you would know because you have to sign a contract stating that you acknowledge that you're going with a surplus insurer. And the best way I can explain is it's like the equivalent of FDIC insurance with your bank account. If you have a bank account with Capital One or Chase, you've got up to, I think, $250,000 in coverage on your bank account. So if that bank goes bankrupt, then the government basically bails you out up to whatever amount you have, as long as it's less than that threshold or equal to that threshold or lower. So in Louisiana, Louisiana Guarantee Association will cover you up to either, I think it's $300,000, maybe $500. I have to go back and look, but it'll cover you up to $300,000 on your homeowners if you have a loss and that company goes bankrupt. So here, Katrina is a good example. We had a ton of insurers go bankrupt or left the state and just refused to pay claims. If they were an admitted insurer, admitted means that they are basically paying 1% of their premium to Louisiana Guarantee Association, so that if something happens to them, Louisiana Guarantee will come in on your behalf and take care of it. Now, they still will only honor those claims based on the language in their policy. And our office is right next to the Louisiana Guarantee Association. And so we've talked with the head of that. And he said, oftentimes people are surprised when they get us to take on their behalf, that we still have to go based on the letter and the law and their policy. And sometimes they're disappointed in the outcome. So it's important to know what you have covered in that policy there. But that's a big factor. So in Baton Rouge, we don't have as much surplus lines here, but in New Orleans, we don't even write in New Orleans. So we have a surplus lines called Dover Bay, where we write, and that's been since Katrina. There were such heavy losses there that most of your admitted insurers don't write in New Orleans. So if you are purchasing a home in New Orleans, and you can find an admitted insurer that will write the policy, go with that. But Dover Bay is a State Farm subsidiary, and they have such a huge asset that it's very unlikely that they'll go bankrupt. And because they're a subsidiary of State Farm, they're probably going to be better covered than even Louisiana Guarantee Association, because State Farm has billions and surplus funds to pay for claims. The Louisiana company, actually State Farm Fire, which is fire is insurance term for homeowners, renters, anything that's in that class is called fire. So when you talk about fire policy, it's just insurance jargon. But Louisiana State Farm Fire has over 20 billion in surplus funds to pay for claims. So if you look at I don't know if we, it's probably easier to show you, but I didn't have that prepared for us today. But if you look up LDI, Louisiana Department of Insurance, you can go on there as a resource, and you can find out probably more information than most of y'all care to know. But you can look up finances on those companies. So you can look at State Farm, you can see what their assets are, what their liabilities are, and their surplus is their assets minus their liabilities. So you want to find a company that has a lot of surplus to pay for claims. That's basically what they have to pay for claims. So if they go bankrupt, do you want to be with a company that has $10 million in surplus or $20 billion in surplus? So that's a big factor. Their assets to debt, just like you was talking about with lending, the risk factors with having too much debt. Well, same goes for insurance. If you look at an insurance company and they're kind of heavily debt loaded, then they're probably pretty risky. So if they have 20 million in assets and they've got 18 million in debt, then that's a pretty heavily loaded. I usually say a good rule of thumb is about 50-50. If they've got or 50%. So if they've got $100 million in assets and they've got 50 million in liabilities, that's probably a good balance. Or lower would be better. And then the other factor you want to look at is where they write their premium. So you can see that on LDI. It'll tell you where all they'll show you the Louisiana premium, all the premiums they get for Louisiana versus the national. So like State Farm, you'll see a very small number for Louisiana compared to their national because they write business in all over 50 states. There are some insurers that only write in Louisiana. And Louisiana is a very high risk state. We have hurricanes, just look at last year, we had 3 major storms that estimated upwards of $9 billion for insurance companies last year. And so that's a lot of losses. Those companies that only wrote in Louisiana suffered the most because they had all their risk eggs in one basket. So, you want to steer clear often from companies that only write in Louisiana for that reason. But if they have if they have a good balance on their assets to debt, then maybe a good company to be with. The other big thing you want to look at is their complaint index. And you can find that on LDI as well. So you can report a complaint with the Department of Insurance. If you ever find that your claim wasn't handled properly, or you felt like it was done improperly, or you didn't get a payout when you felt like you should have, you can report it to the Department of Insurance. And that shows as a ding on that company. And you can see how State Farm has compared to Allstate, to Centauri, to whoever. And they've actually created an index on there. So 1 would be an average complaint versus all companies that write business in Louisiana. So if you see a 1 as a complaint index for that company, they were pretty average as far as their complaints. If they're below that, let's say they're 0.5, then they're about half the average of complaints, which is good. You want that to be lower. But if you see a 2 or a 3, it means they're like 2 or 3 times the average in Louisiana for complaints. So you want to see that. There's actually 3 companies, I won't mention names, but they're actually under investigation right now with the Department of Insurance because of how they handled claims last year. So And if you're on their mailing list, they'll send you those things and you can find out about those as well. So I'm subscribed to the Department of Insurance. They send me those articles as they come in. Any questions so far on that? Yes, ma'am.
I want to know if you were in a non-flood zone and you wanted to get flood insurance anyways, would it be the same amount as it is? You know, like the cost would be the same amount as it would be in a flood zone?
No, actually they're different. Yeah, so there's different flood zones. X is the lowest risk. A lot of times people call them a no flood zone, which is inaccurate because it just means that it's 1% or less chance of flooding that year. So like I live in an X zone. I live in Hickory Ridge, and if you look on a map for FEMA handles everything with flood. Even flood insurance is actually written through FEMA. It's actually it's called NFIP, National Flood. It's a National Flood Insurance Program, but it's basically through FEMA. So all flood is actually written through the federal government. So I can write the policy, or Allstate, or anybody. It's all going to be the same. And a lot of times people don't know that. But we have an account. We log in. We can rate it for you. An X zone, pretty much everywhere in Baton Rouge or surrounding areas, an X zone for $250,000 in dwelling coverage and $100,000 in contents is going to run you $572. Yeah. So the way they do their policies, they're tiered. So $250,000 is the maximum you can get for dwelling flood insurance, and $100,000 in contents. And so that's when you get a quote from me, it'll actually show different brackets. And so the lowest one is the highest maximum amount they can cover. And for an X zone, it's $572 for that coverage for the year. For the year, correct.
Okay, so if I had insurance with another company like Homeowners Insurance, could I still choose like the flood insurance with another company?
Yeah, and often we do. Like I have friends of mine that we try to quote the homeowners, and it just wasn't it just didn't fit for them. But they still wanted me to do the flood policy, and so we can absolutely do that.
And you have to still contact I guess the mortgage company or whoever.
Sometimes we do. Different mortgage companies they're different. So some will say, yeah, we'll escrow it. So if you wanted your insurance to be billed through there, so it's in your monthly payment for your mortgage, it's through escrow. Okay. And so we would just send them a mortgagee deck page, just like we would for homeowners. So like if you're closing a home, the lender is going to reach out to me and they're going to say, John, we need the mortgagee deck page. They call it a mortgagee clause that they. What's that? What kind of mortgagee? So the mortgage company is the mortgagee. Okay. It's just it designates that they're the ones that's writing the mortgage. So the mortgagee, and then it's a declarations page or a deck page. The declarations just states like what the coverage is, what your premium is. And so they want that so they know, because when we send that, it also has a billing, so they know where to send the bill, the check to. So FEMA, because it's through the federal government, they don't do it monthly. If you don't do it through your mortgage company, then they want the full amount up front. So if that's not possible, we will try to do it through the mortgage company. You will have to ask the mortgage company if they're willing to do it, though. Every mortgage company is different. I've had some where they say no, which to me doesn't make a lot of sense, because if you're willing to pay it and you've already been approved for the loan, then I don't see where it really would matter. The only case where I'd see it would matter is if during a loan closing, they've only approved you for X amount monthly payment. Then they may decline it because it adds an extra, whatever that is. I can't do the math in my head right now, but if it's $50, yeah, I guess it'd be about $50 a month. If it goes over that threshold, they may say no, but they may do it after the fact. So you could also ask them a month or two later if they're willing to do it. If it's an X zone, if it's required for the loan, it's above an X zone. So it's an AE or A. And so those, they have to be escrowed through the mortgage company, because it's a higher risk. So the mortgage company will not let you get the home without that flood insurance. And then if it's part of loan closing, you're exempt from the 30-day wait period. So with flood insurance, there is a 30-day wait if it's not required by the lender and it's part of the loan closing. Then, and it is required by the lender, then you get what's called a loan closing date. So whatever the date of the closing is, you're covered. But otherwise, and it's just prevent people from during flood season saying, you know what, I want to go ahead and get it. And so they give you it basically from the day that you submit payment. 30 days after is when the coverage starts with flood insurance. So even if you want to do it at a loan closing and it's an X zone, just so you're forewarned that there'll be a 30-day wait period on that if it's not required by the lender. And so sometimes people will pay it up front a month before, but there's a risk with that because you haven't closed on the home yet. So just bear that in mind.
Okay, so if it's getting ready to be another, like a renewal, like every year when it's time, I guess they pay you once a year or something like that.
Yeah, the escrow will pay the insurance up front for the year each year. So if you're not sure when you pay it, it's usually at the anniversary of when you bought the home. So if you know you bought it in October last year or 10 years ago, most of us remember when we bought our home what time of year it was. So that's the easiest way to know. But if you don't know, you can also you can log into your mortgage statements and you can see the escrow tab, and that'll show you when insurance was paid, and it'll show who it was to, and it usually will have the policy number. So then you can reach out to that company, and we do this a lot for customers because we want to make sure that it makes sense for them to switch before they do it. So I'll ask a customer to go ahead and log in their account and find out who the insurance is through, then reach out to that insurer to send them an updated declarations page so that we can compare it to make sure it makes sense for them. Does that answer your question on that? Okay, perfect. And to talk about credit, credit is more and more becoming a rating factor for insurance too. Yes. So if you know your credit is not good, then don't volunteer, because I've seen sometimes where I'll ask a customer, if they want to, if we don't find a rate that's looking very good, I'll say, well, part of rating with insurance does have credit, and I see that we don't have a social security number. If you're comfortable giving it to me, I can go ahead and run it. And it's a soft hit, so it's not like a loan. The reason your score drops when you run your score for lending purposes is because if you're going to multiple lenders to try to get loans, that can be risky for them. So they drop your score. When you're doing it for insurance, it doesn't do that. So there's no risk for you to run it. So if you know you have a good score, go ahead and let them run it for insurance purposes. But if you know that it's not very good, then it doesn't help you to have it. So, if they ask you for it, you don't have to give it to them. It's not required for insurance. It's just, it can be a rating factor if they have it. And a lot of times we will already have that social security number on file. I don't see the full number, and I don't see your score either. It doesn't tell me when it was ineligible, why. So, like I have a brother-in-law that wanted to get his insurance, and I asked him if he's comfortable giving me social, and he kind of hesitated at first. And I said, look, I'm not going to see your score. I'm not going to see anything about your credit, because I don't need to know. It's just underwriting. It's going to use it to see if you're a lower risk, they're willing to give you a little premium for it. And he was fine with that. So just bear that in mind too with regards to credit. But
then you said it was a soft pull, right?
Yeah, it's a soft pull. It'll show up on your credit report that State Farm pulled it, but it won't lower your score like applying for a loan or something like that. I think if it does anything, it's like a quarter of a point or something like that is what I've been told, but I don't know that it does anything.
A soft pull doesn't hurt, only hard.
Right.
But what is a soft pull? I explain it.
Yeah. Yeah, it's just a way that when they say hard hit, it's just think a hard hit. It's it's like a big hit in the face. It's just a little tap on the shoulder. We're not gonna. Then and stats for flood insurance, by the way. So like I live in an area that's never flooded. 16, we never had water in the street. In Hickory Ridge, my brother-in-law lives in the same neighborhood as me, south of me, and because he never flooded in 16, he thought, well, I never need flood insurance, because if it didn't flood in 16, the big 1,000-year flood, I'm good. Him and several of his neighbors around him got 6 inches or more of water just in May, and he didn't have flood insurance. And the average flood claim, according to FEMA, is $53,000, or $51,000 or $53,000, above $50,000. And it's not like a homeowner's claim where you might have some roof damage. It might be $5,000. It might be, $1,000. You could have a total loss of $100,000, $200,000, but most claims with homeowners generally are pretty low comparatively to flood. And that's why flood policies are always done through the federal government. It's such a risky business that insurers just don't want anything to do with it. And so the federal government pretty much kicks in and they subsidize it. And it's pretty cheap when you compare to like the risk that it is.
So if you do have your homeowner's insurance, it wouldn't cover nothing, even though something got there in the flood, like it wouldn't cover anything.
Insurance is based on the peril or the cause of loss. So if you had a pipe burst in the attic and the home flooded necessarily because of the pipe, the cause of loss was not flood, it was actually the pipe. That's covered under homeowners, even though the house flooded. It's based on the cause of loss. So yeah, you're right. So flood is generally if you and maybe at least one other person in that area got waters due to a storm or rising waters in the canals or whatever. And it's a pretty low threshold when you think about it. At least you and one other person in that area has to have some kind of flooding for it to be considered a flood, and flood insurance will kick in. Yeah. Because people ask me that all the time, and I've looked it up, and it's only 2 people in any given area for it to be considered a flood. And then the other stat that FEMA gave us was you have a 1 in 4 chance in a 30-year period, because most people do a 30-year mortgage. You have a 1 in 4 chance of flooding in a 30-year period, even in a low risk area. And because we can always engineer ourselves in a flood, a lot of areas in Baton Rouge flooded due to human error. Just in my neighborhood, one of the houses, they stated the reason they flooded was because it was on a Sunday evening and everybody put their trash cans out for the trash pickup, and a lot of trash cans fell into the street and water travels wherever it's going, and it covered the storm drains. And so if it wasn't for that trash can, or several probably, that covered multiple drainage areas, they wouldn't have flooded. And so, but that was still covered under flood insurance if they had it. Let's see here. And then kind of to touch, just because I know we were talking about home insurance, but one thing that I did want to touch on was also on your liability limits with your auto coverage. In Louisiana, the state minimums to drive legally in Louisiana is 15, 30, 25. And so that's 15,000 per person, up to 30,000 per accident and bodily injury, and then 25,000 for property damage. So you have a split limit for bodily injury. So if you have one person in an accident that you're liable for damages, the state minimums means that, whether you're a Geico, State Farm, whoever, they're only contractually obligated to pay out $15,000 per person. With medical expenses so expensive today, in most cases, it's really quick to exceed that. I've seen claims where they had $100,000 in damages. And so you always want to make sure your limits reflect your assets, and in some cases, your annual income. Because an attorney, a judge can, an attorney can subpoena for assets in the case of a liability claim. They can say, we want to subpoena for assets on Kenyatta, and they find that she's got, a couple paid for, Lincoln Navigators. She's got 2 houses paid for. She's got, $100,000 in the bank, and she's got state minimum coverages. When they go to court, they have to decide whether they're going to go for the insurance money or they're going to go after Kenyatta personally. And if she's got $15,000 in bodily injury and she's got a net worth of $1 million, who do you think they're going to go after? So, and people are often surprised that to increase those limits doesn't necessarily mean it's a huge amount more. And in the case of, sometimes we'll, like in Kenyatta's case, we actually increased our limits and substantially, and it didn't really actually still save your money. And we see that in a lot of cases. And unfortunately, in our business, it's become so transactional that people don't even know what those are, and they say, I want full coverage, thinking they're fully covered. And Mr. T was one of my heroes as a kid. I was kind of a dork. And so on my wall, I have this picture of Mr. T saying, I'm beautiful, who got full coverage. Because they have full coverage, but they got state minimums and their attorney and an engineer. I actually had a case where I was working with a guy at state minimum coverage. He had paid for Lincoln Navigator. He had paid for fully loaded F-150, both worth about $100,000, mind you. And he had 3 rental properties and a home. And I talked to him about liability. I said, well, let's just look at property damage. I said, how much is that Lincoln Navigator worth? He said, oh, it's $100,000. I said, it's paid for, right? I said, if somebody totaled your Lincoln Navigator, would you want it to be, restored or, replaced? He's like, well, yeah. I said, well, right now you would only cover $25,000 if you get someone else's paid for Lincoln Navigator. How would you feel about that? He was like, I see what you're saying. I'm looking at my parking lot here where he worked, and he said there wasn't a car in that lot that was worth less than $50,000. And in most cases, to go from $25,000 to $50,000 is usually about $1 a month more on their insurance. And it's just a matter of asking, just to find out. So whenever I meet with customers, I always kind of look at the whole picture, and I get a little personal because I kind of ask you what you have, but it's because I'm a risk advisor. I want to make sure that your coverage reflects what you have. Because the opposite of that, when I was just getting off my parents' policy, my dad was a surgeon, and I didn't know what liability was. I just was like, I'm just gonna have whatever my dad has. He had 500,000 single limits on his auto coverage, which as a college kid, I didn't have any business having $500,000 in liability limits. Of course, anybody would go up to an insurance for that because I wouldn't even worth probably $10,000. So I was overpaying for my insurance for years because nobody ever had that conversation with me about my liability limits. So, any of y'all, I'd be more than happy to take a look at what you have. At the end of the day, even if I couldn't earn your business, I can at least advise you on what you have. Oftentimes, I can't tell you how many times I've had a customer where we couldn't even come close to what they were getting with their current insurer, but there was a gap in coverage. A common occurrence on homeowners is backup of sewer. It's not covered under homeowners unless you have the endorsement included. And that endorsement's usually only about $10 to $20 a year. And it's one of the more common occurrences on a homeowners if it's not related to a storm, especially if you live in a condominium or a apartment complex. Because you can imagine with all those different people close together, somebody might put something down the toilet that isn't supposed to go down there, and it causes a backup event to everybody else. And so I always include it on all my homeowners, but it has to be an endorsement on a homeowners. And I can't tell you how many times I've seen somebody's declarations page and it's not included. And even if I couldn't earn their business, I'm like, hey, look, reach out to them and ask them to include the backup of sewer. So one other thing I recommend on homeowners is your liability, because the minimum you can put on a homeowners is $100,000. And if you think $300,000 would be more sufficient, in most cases, it's like $9 a year to include $300,000. Triple your liability protection for, less than $1 a month.
So if I have homeowners insurance through State Farm, but I need to look at my policy because I don't know anything about it.
Sure. You have State Farm?
Yes, I do.
Okay.
So I just need to make sure.
Who's your agent?
They in Pontotoc.
Okay. But you live here?
No, I'm in
Okay.
Pontotoc.
Oh, so you traveled all the way here. Well, awesome. That's great. So, and you have both auto and home?
No, so I probably need to look at that too.
Yeah. Yeah. Let me
My
take a look.
homeowners is in escrow, so they just paid here. They just paid it for August.
So the homeowners is State Farm?
Yes.
So you're overpaying on your homeowners. Because generally the savings, the bundle home and auto is about $900 a year for most of my customers. So you're probably, just the savings to bundle it on the homeowners alone, probably, even if we're a little bit more on the auto coverage, because you get such a substantial discount on the homeowners, it'll probably make sense. But I always do all my customers, I'll look at the whole picture and make sure if it makes sense to bundle it or not. But yeah, it's a 15% discount on the auto, and on the homeowners, it's generally like a $700 to $1,000 discount on the homeowners too.
And I want to make sure about the backup too. That is, I don't know.
Yeah. If I add you in my system, I'll see what policies you have, and I think I should be able to open that. I know on auto I can see all your coverages, but I'll double check and see if I can see your homeowners. If not, we can ask the agent to send it to you before it to me. At least 5 on it.
Yeah, business card.
Yeah, I'm gonna give everyone a business card and absolutely. Yes, ma'am.
Do different state farm have different rates?
They're all the same. So whether it's State Farm with Stephen Brookshire State Farm, which is where I work, or any other given name in Louisiana, as long as it's in the same state, the rates are all going to be the same. The only difference is if they missed a discount. I'll go through all the discounts with all my customers. Some agents are a little less apt to volunteer drive safe and save, which is a beacon in your car, an app on your phone. I use it in my car and it saves me 10% on the auto. Some people don't like it because they think it's invasive, but to me, if you have a smartphone, you're already being looked at by everything because whether it's Google or because Android's Google or Apple, they're selling your information to everybody. So State Farm doesn't give it to anybody. It's just used for rate purposes, and it just looks at braking, how hard you turn, and mileage and accelerating. And even if you're just an average driver, you're going to find a 10% savings with that. But a lot of your older agents don't like to volunteer that as a discount. And so if you didn't have that discount with them and I showed that to you, yeah, it would be a lower rate, but it's the same rates. It's just, whether there is detailed design about making sure you have all the discounts you're eligible for. If you're 55 and older and you take a defensive driving course, you can get a 10% discount on auto as well. And so some people don't know about that. Most insurers do that. So Geico does it, Progressive does it, State Farm. So if you're 55 or older, there's an online course you can take, and it's good for 3 years. And it might take you 40 minutes to an hour, and it costs you maybe $20 for that one time for 3 years. And it on average saves most people $100 to $150 a year on their insurance.
Do it make a difference if you have State Farm in Louisiana, State Farm in Mississippi?
No, you can. I have customers that have. You can still get the multi-line discounts, whether it's no matter where it is in the country.
So there's multi-line. Explain that.
What's that?
You said multi-line? So
Yeah, multi-line discounts. So if you bundle auto with homeowners or life insurance or disability, I think I'm missing one. Those are the main ones. Or renters, renters insurance. If you don't own a home and you rent, a lot of times the discount almost pays for the renter's insurance. And renter's insurance doesn't just cover your contents; it covers your liability too. So again, it closes that gap between what your auto doesn't cover. Because an attorney, the first thing they ask when you get in an accident is, where did the accident? When did the incident occur? Was it like in a car or was it not? Because they want to know what insurance they're going to go after. Are they going to go after auto insurance or fire, which would be your renters or your homeowners? So it's a difference. How are we doing on time? Do we have time to do any more questions or?
It's almost time.
I think that's it. Well, if y'all have any other questions, y'all can reach out to me. I'm going to give y'all my card, and if y'all want to pass these around, whatever y'all have left, I'll take. And I don't have my personal cell phone on there, but if y'all want to write it down, it's 225-456-3647. That's 456-3647.
and what was your name?
John.
You said 367.
3647.
All right, that was a great presentation. I told y'all he's very thorough and he will educate you. So we don't have that much time, but I promise I won't hold you long. I'm just going to touch a little bit on credit, and then I'm going to touch a little bit on business taxes. So why your credit matters? I'm going to tell you why your credit matters, because you want to get what you want. You want to get what's due to you. You don't want to have to settle for anything. So that's why your credit matters. So what makes up credit? Let's talk about length of credit history. How long you had something. That does matter. I have a lot of clients, they get a loan, they want to pay the loan out. That is a good thing. Sometimes I wonder if America just wants us in debt. But let me tell you why you don't want to close that account out, especially if you in a credit repair process to buy a car or especially to buy a home, because when you close that account out, it will drop your credit score, even though you had a perfect payment history. Yes, it do. Another thing, inquiries. Inquiries does make up part of your credit mix. And the reason being is because if you constantly let lenders, anybody run your credit score, you're going to cause your credit score to go down. And if you have too many inquiries in a short amount of time, you're going to get declined. You can have a high credit score, you can pay everything on time, but if you constantly letting somebody run your credit, they're going to think you're in desperate need of credit, so therefore they will decline you. Another thing I want to talk about is the mixture of credit. You want to have at least 3 to 5 credit cards. And with those credit cards, you want to keep your utilization below a 30%. Now, it's best to get it at a 10%, but I understand some things happen. But if you can get it 30% and below, great. You'll maximize your credit score. A lot of people say, well, hey, I spent the money, but I paid it back. And yes, you paying on time. But how the lender is looking at it and how the scoring model is saying, well, she using all of her money. She must need it. So they're going to rate you as a risk factor. And that's going to cause your score may not go down, but it may move a few points. So keep your utilization for your credit low as possible. Another factor is payment history. That makes up 35% of your credit. Pay your bills on time. If you feel like you're going to be late, ask for help, ask for extensions. I can't think of it off the top of my head, but there are programs out there to help you. For home loan, for one, if you fall into a pit, forbearance. Another thing I want to talk to you about is student loans. Right now, everybody should be safe with their student loans because you don't have to pay anything right now. And that program is going to end sometime in 2022. What they keep on extending it. January? Okay. So y'all have good time. But if they don't extend that, just keep in mind that there are so many different type of programs you could get on. You could get on the income-driven base plan where you pay $0 a month. There's the IDR plan, or you can choose to pay a minimum payment. And a lot of people don't want to pay their student loans. I'm always say pay something. If you can pay $20 or $25 a month, that's great. Because once that program is over with next year, the interest is going to start back adding up. And you wonder why you have a balance of $5,000, but the high balance is $5,300. That's that interest. Another thing you want to do with your student loans is consolidate. You may have 10 accounts for your student loans. If you consolidate that, that means the student loan company is going to pay that off. So it's going to cause your credit score to go up. And then not only will you have 10 accounts, it's going to be 0, and you're going to have that one account for your student loan just for you consolidate. There's 2 different kinds of scoring model. A lot of people say Credit Karma is not accurate. Credit Karma is accurate. You have your Vantage score and you have your FICO score. Credit Karma uses your Vantage scores. So the scores may be higher or lower than your FICO scores, but whatever on that for Credit Karma is indeed probably actually yours. Now, when it comes to FICO scoring, the lenders use FICO. And how they determine what your FICO score is going to be to qualify you for the home, they're going to use your middle score. You can have a 580 with TransUnion, 592 with Equifax, and a 576 with Experian. They're going to use that middle. So it go from high, medium, low. They're going to use the one that's in the middle. Another thing about credit, you want to make sure that you're not letting people run your credit so many times. The difference between a hard inquiry and a soft inquiry. A soft inquiry when somebody just looking at your credit to see if they want to extend you some money or something like that. Another thing with a soft inquiry, let's just say you're working on your credit, you're paying everything down, your score is going up. And out the blue, an account just pop up on your credit report. This is what they do. They monitor. One credit monitoring site that I use, I actually can see if anybody's looking at your credit. And that's how I'm able to warn some people, hey, this might be coming up. So if your score is going up and the things are coming down, they're going to figure you have money and you're paying those accounts off, then bam, something hit your credit report. It always happens like that. So that's something to think about. So a soft pull, let's just say you have a credit limit of $10,000 and you make a late payment and your credit score drop. Well, every so often that company will look at your credit report to see how you're doing with other companies. So if your credit score drop and you have a $10,000 limit, they're going to reduce it. I have seen it happen. And you wondering why they're not going to give you an explanation or they're going to come up with a phony explanation. That's exactly the reason why. So that's the soft inquiry. A hard inquiry is when you're giving someone your social security number to run your credit. So y'all got any question about the hard and soft inquiries? So yeah, you got that? Okay, good. With credit, what I do is I look at the credit report as a whole. I'm very thorough. I do free consultation. I like to talk with my clients to see what's going on with each account because the account may not be yours or the account may belong to your daughter. Like a lot of times when you take the child to the hospital and you are the guardian, you sign it for that child, you wonder where this medical bill coming from because you're guardian of that child, they put it in your name. Well, one, you can't do that because that is not me. I didn't use my social security number. You did not treat me. You treated my child, which is why so many people end up with medical bills on a credit report. Another reason why people end up with a lot of medical bills on a credit report is because you may have insurance, but you went to see the doctor for an x-ray, but when billing and coding got your paperwork, they probably put it in that you got your toe amputated, and you wonder why the insurance company is denying that claim or why you have this medical bill, because medical billing and coding, they put in the wrong code. So those are some things. Yes, ma'am.
The medical bills for against your,
They don't hurt as bad. I'm not sure what percentage they count, but it's not a major factor. So that's something else you can ask the lender. I know a lot of things, but I'm not detailed in that particular area. But I know that it's not a major factor of hurt you so bad. You want me to say?
Yeah, it's just like I was just saying, it's all of them, they don't count. Some of them they do, but it's let them know, the guidelines, which ones they count and they don't count.
but they do show up.
They show up.
They show up. They show up. And another thing, a lot of people just don't want to pay what's on their credit report. I understand that too because I didn't do it. But when you're trying to get something, you may have to just go ahead on and settle with them. You can do a pay to delete, or you can just pay them in full. Me personally, I want to do a pay to delete because if I'm going to pay you, then you're going to agree to take it off my credit report. So it's not a bad thing if you do decide to pay some things off of your credit report. So just keep that in mind. I will start with the lowest account possible. Now, when it start getting high into the thousands, you know what? I'm not paying this. I'm going to dispute this. So that's how I feel. I'm going to talk about online disputing. Online disputing is not a bad thing at all. But the thing is, if you do online disputing, you're giving up your right to sue. And I say that because online disputing is a little effective, but y'all have rights. Y'all have consumer rights. Y'all can contact a consumer attorney. And a lot of people don't even know that if you're going through the dispute process, there's a chain of command that needs to be followed. The dispute flow, the responses, you have to respond in a timely manner. If they choose not to respond to you, ignore, you can file complaints with the Federal Trade Commission. You can file complaints with the Consumer Financial Protection Bureau. But you have to be patient in that process because some companies may went bankrupt, or like with the pandemic, a lot of companies have shut down, so they're not responding to you. Well, if they're not going to respond, either you're going to take this off my credit report. And if you decide not to take this off my credit report, then I'm going to contact a consumer attorney. A consumer attorney will take your case with no money up front. They will get their money once they are taken to court with that company. But the only way they'll look at your file, but the only way they're going to take it, you have to follow those chain command. You have to keep the documentation, paperwork, and it is best to get tracking whenever you're sending your letters out. That way you can either somebody can sign for it, or you'll know that for a fact that it's actually been delivered. So that's another thing y'all should keep in mind when it comes to the credit process. Now, when I start, I'm going to look at everything as a whole on your credit report. My consultation lasts anywhere from 30 minutes to an hour. Credit building is very important, and I always stress credit building. You absolutely need something reported to the credit bureaus. That's the only way that you're going to build credit. If something was to come off, yes, your credit score could go up. But if you don't have like a car note, a credit card, a secured loan, unsecured loan, or something of that nature, reporting every single month, you won't see your score move, and you may not be approved for anything. You can have, I'm going to use my daughter for example. That's my daughter behind me, y'all. Her credit score, last I checked, was at 725. She's on all of my credit cards. And that's how I was able to get her score up that high. Now, when she goes to apply for a loan, would they give her a home loan? I don't know. I guess she gonna have to have something else. She don't know, but I was gonna get a credit card in her name, and I wasn't gonna give it to her. So that's another thing that I'm gonna do so that she can have that mixture of credit. And that's something that you might want to do. You might want to add your kids to your credit cards. You can start as early as 13 and start doing it now. Discipline yourself to not overspend. Discipline yourself to pay that bill on time. And if you feel that you're going to forget, make sure you put it on auto pay. So do y'all have any questions about credit? I don't want to keep y'all too long. Credit, I could go in detail a lot. So I take y'all questions about credit.
I'm not going to ask more questions this time. Okay, so when you said we had to get about 5 credit cards, right?
3 to 5.
Okay, 3 to 5.
Mm-hmm.
Can secure credit cards count as one of the 3 to 5, or it has to be the regular credit cards?
Secure credit cards definitely can count.
Okay. That's all I want to know.
And if you get your child on your credit card, would that hurt your credit if they have bad credit?
No, don't give that child that credit card.
You know what I'm saying? If that child is older and they do have credit cards of their own and they're trying to build their credit, will that hurt your credit if their credit already bad?
No, ma'am, because all you're doing is adding that child to your credit card. Their credit file doesn't have anything to do with you. Yes, ma'am.
I can say this, I did the same thing for my son.
Mm-hmm.
I got him a credit card and I didn't use it then.
Mm-hmm.
Yeah, I basically used it and paid it off, but I didn't use it often. I paid it off. He had it 2 years before he got out of school.
Okay.
Right at school, yeah, right around that time. He was able to get his first card, but that was the only credit he had.
Right.
So, you know, it actually worked. But I didn't know, I wasn't told that for him. But I did do that to bring his credit score.
Good. That's awesome. And Capital One? Yes, ma'am.
As a realtor, we was doing that some time ago. And the credit bureau, they, I don't know if they stopped, but they started holding, trying to hold, not the child, like we would use credit cards to, you know, like you have a wife's credit up to $2. And they started using, like if he was late, they'll hold it against the wife.
Yep.
If the wife late, they'll hold it against the husband.
That's right.
I'm trying to say that it stop. I know it was good at the beginning. We could dispute it and say, no, it wasn't mine, so you can't do it, but then it stopped. And how they doing it now?
It's challenging. Sometimes it's gonna work and sometimes it's not gonna work. You might be lucky if it come off your credit report. Nowadays, they say, okay, if this is not mine or I'm not responsible and it's on your credit report, they want you to get a police report. And a lot of people don't want to get a police report.
Well, I just had that same situation. My daughter had a card and she had me authorized on it. And it got behind, but I was able to call them and they took me immediately off of it. And it did make my score go up.
Good. So, and that's another option that you have. You can reach out to that lender.
When you get the security card, what do you advise us to spend all of it?
Gas, Netflix. If you have a $200 secure limit, don't spend no more than $60. If you could keep it below $60, great. But some people use it for gas. Some people use it to pay their Netflix bill.
Now, what if I get one, not necessarily a secure one, but just a little small one?
Mhm.
And I get like gas and this and that, let's just say I get one for $300.
Mhm.
And I use that entire $300, but I pay it off before the bill.
Mhm.
Does that work against you because you say?
Yes, it do. Yes, it do.
Okay.
Now, your credit score probably won't go up a whole lot. It may go down a few points, or it just may be stagnant. It's because you use all of it, and what's reported is a high credit limit.
Okay.
So I recommend don't do that. You
I
can
can
ask your
tell you,
question.
you were telling about, don't close out that account. That was a funny story when my wife and I were buying our house a couple years ago. They weren't going to let us use her income because she had a 0 score.
Mhm.
She had student loans she'd paid off. She paid off her car, and she, got off her parents' credit card. And after, I don't know what timeline you might know, but you basically become a ghost. And she literally had a 0 score. And so they said, we can't use your wife's income because her credit would just be, he said, but to be honest, John, just open a card in her name and I'll run it the next day. And literally she had a higher score than me. I think I was like a 740 and she was like a 770 or something like that.
Wow.
So
Yes.
if you have had good history in the past and you don't have any kind of credit, just opening up a credit card, can very instantly improve it.
Right. You can see your score go up anywhere from 20 points up to 100 points. It really just depends on your credit mix, on how many points you actually able to get.
But I didn't think that was, well, I just recently found out actually having a 0 credit score. I didn't think that was true. But my friend, she always paid everything in cash. She had paid off a house years ago. But she said, well, they told me I got a 0 credit score. I said, it's not true. You don't just start with 0. But I guess so.
Yep.
But I looked it up and it's
So here are a few things you can do to build your credit. You have some paperwork in the folders. If you don't have a folder, I can get you a folder. Self. They used to be known as Self Lender, and they changed the name to Self. Self is FDIC insured, just like a regular bank, and it has a CD. The money is locked into a CD. I always go with the lowest plan. I think they have 3 or 4 different plans. And I set mine on auto pay. I pay $48 every single month. At the end of 12 months, I'm going to get that money back. I always start in the summer. That way, when the 12 months is up, I have that money, that check they sent to me, and I'm using that as a vacation money. Or if you want to start in July is gone, but if you want to start in July or August, that could be money for your kids' school uniforms. So Self does report to all 3 credit bureaus, and that's a great thing. And that's what you want. You want an account that's going to report to all 3 credit bureaus. There are some accounts, especially credit unions, some credit unions, they only report to Equifax. That is good in a way, but you need something that's going to help all 3 credit bureaus. Another thing you can get, credit builder loans. You can talk to your bank. Always go talk to someone in your bank. If you're not with a credit union, get with a credit union. Credit union really do help you in opposed to some of these bigger banks like Whitney Bank, Hancock Bank. Honestly, I don't like those banks. Capital One is a really good bank. They are a bank of second chance. And I tell people when they mess up something with Capital One, especially a credit card, or if the balance is low, I always tell them, just go ahead and pay it. Capital One is a bank of second chances. Chase Bank, they're okay. They're okay in my book. Bank of America, they are pretty good as well. So those are some of my top choices when it comes to banking and doing business. Well, you want to get in the habit of going inside, if they'll allow you inside, and speak with a teller. Be transparent, honest, because when they pull your credit report, they're going to see what's on it anyway. Hey, I have bad credit. I need help. I need help establishing credit. I need help rebuilding my credit. I need a credit builder loan. And you be transparent. Some banks, they may want you to put $500 in a CD. Some of them may even give you a $500 loan and you just pay that back over 12 months. No matter what, just make sure that whoever you go to, they are reporting to all 3 credit bureaus.
a lot of people like to use Experian Boost. It's good, okay? It's good for Experian because those accounts are only reporting to Experian. So it's really no benefit when you go to get a home loan and they have to look at all three of the scores. So I think that's all I'm gonna touch on with credit because I could go on and on. Do anybody have any more questions about credit?
How many times are we reporting to all three?
Pull your credit report. You can look at Credit Karma to see if it's on there. Experian, they are free. Now Experian actually has your FICO credit score, and that's how you can look at all three, and that's free.
No, I'm saying if you get a loan or anything.
Ask them.
Yes.
Now,
credit is not easy to deal with.
really? Y'all don't think so?
They
I think
don't-
they would do it better for you because they know you know what you're at.
But I've been having, I've been with Essential. I've been having them since I was 19. So
I think it's better, 30 years.
Because, they did my car, but they wouldn't do my house. And I went, but I went somewhere and they just fine with getting my house. No problem.
Wow.
They wouldn't even look at it.
I did have one, Iberville Federal Credit Union in Plaquemine. Oh my God, they would not help me for nothing in the world. And I couldn't understand why. My check was going payroll deposited into the account. They wouldn't help me. But I've been had Essential. I said, well, I just, I knew a lot of people in Essential. I just didn't want, But I went through Essential. I got my car refinanced. And all right, so I'm gonna tell y'all a little bit story. Maybe this could be motivation for y'all. Don't lose sight of the prize. Don't get to the point. Don't get discouraged. Also, don't get greedy and say, "Hey, you want something else?" Because when I wanted to buy a house, I had a repo, and I got so discouraged. I kept disputing, kept coming back verified. I just got discouraged. So I said, you know what? Forget it. I'm not gonna worry about it. I'm not gonna do it. I couldn't get the house because I had that repo. That I think it was $15,000. So I was so upset. I do silly stuff when I'm mad. I go on a shopping spree when I'm mad. I decided I'm right now for the Boulevard, and I decided to call a lady at a car lot, and I went and got me a car. I wanted an Acura, and I went and got an Acura. And guess what, y'all? 2 weeks later, that repo came off my car, off my credit report. I was just done. So I contact the lender, and when they pulled my credit report, by the time I decided to contact them, the car note hadn't already hit. I couldn't qualify for a home because of my debt to income ratio. And even though I'm self-employed, I was not properly reporting my income. So I found myself in a wing, and I had to wait, and I got discouraged all over again. Sometimes we move when we're not supposed to move. We move it on our own behalf when all you have to do is just be still. And that's it. 2 weeks later, y'all, 2 weeks. I was just rushing, I was just discouraged, and I was making silly decisions. So when I finally was able to qualify for a home, they told me my debt to income ratio was too high because of that car note. So what I did was I got my car refinanced. I put a little money down just to try to buy it down, and I'm saving hundreds of dollars in interest, and I was able to qualify for my home. And I have a 2.25 interest rate, so it can be done. Y'all have to put in work. Sometimes it's easy to say be patient. It's hard because you want what you want and you deserve what you want. You're working in this world every single day. So life gonna happen, things gonna come your way. Just stay motivated, stay encouraged, no matter what. Now, as far as business practice, this is one of my favorite things to teach on because, again, I made a whole lot of mistakes and I learned through trial and error, or, they say a board lesson is a taught lesson. I'm definitely a board lesson. So when it comes down to being self-employed, that is a great thing. In this day and age with everything that's going on, you always want to have something on the side. And that side hustle may turn into your full-time business. You may want a house that costs $200,000. You have your job income and you have your self-employed income. But because you don't want to report all your income to the IRS because you don't have to pay that money back, or if you have kids, you miss getting, because I do miss getting $7,000, $8,000 refund checks. Lord, can y'all go back to me, little? Oh my God, I miss all of that. I was on food stamps. I was on Medicaid. I love all of it. But I was hindering myself. I was hindering my growth because I would not move. I was enjoying the benefits. So when it came down to me deciding to, okay, this is what I want, I couldn't get what I want because I was doing right on paper. So you want to report the income, even if you don't report all, just enough to get you qualified. Again, Emmanuel is thorough. You got to talk to him. Maybe y'all could set up a consultation one-on-one. I'm not an expert when it comes to that, but he was very thorough to me. I couldn't get what I want. I had to get what I could get at the time because I did not report my income. So I'm looking on the brighter side of the future. I'm going to turn my current house eventually, one day. That's going to be my rent house. I chose to get a cheaper house. You can get whatever you want, but I chose to get a cheaper house, something because I was tired of paying $800 rent too. But I want to become a landlord. But if I'm paying $1,000, $1,500 in mortgage, it's going to be hard for me. So always look at the bigger picture. Get a tablet, write your goals down, get a prayer request book. Let your request be known to God. It's in the Bible. And that's it. That's all you have to do. But report enough income so you can have whatever it is that you want. Those deductions that people take, where they writing everything off, only thing it's going to do is it's going to hinder you from getting whatever you want. We live in a society where everything is being watched, monitored, and documented. Unfortunately, to get what you want, sometimes you have to just play by those rules. So when it comes to business taxes, you want to keep accurate paperwork. You want to keep your receipts. There's something called QuickBooks. With QuickBooks, you can upload your receipts, all your paperwork, and they're going to determine if it's expenses or leisure. A lot of times we can actually have leisure, like right now. Let's just say, or I'm going to put it there, I was throwing a party, but at halftime during basketball or football, I decided to get my credit materials and I'm passing it out and I'm talking to y'all about credit or about taxes or something business related at halftime. Guess what? Hello. Yes, ma'am. Yes, ma'am. Whatever I spent on that party, the food, the drinks is paid for. And I'm gonna use this as an example. I didn't personally do this, but I had a tax mentor and she was showing me a lot of different things. And sometimes in life, somebody who's above you, you have to pay them. So they will charge you, but you have to pay them so that you can learn.
Right.
Mm-hmm. Well, she was doing this lady taxes. She's a realtor. The realtor sells big old homes for like millionaires. Well, the lady had bought a yacht. And when she bought that yacht, you could write a yacht off. Know how she could write that yacht off? She was using it for business. When she would throw parties like appreciation party or customer appreciation party, something of that nature, and she talking about realtor, or she passing out her cards. Now, granted, she's gonna take some pictures. Like she was supposed to take my pictures today. She's taking some pictures of her talking or maybe videoing herself, and it could be about 5 minutes of talking about her business. So she's doing all of this on a yacht. Yacht costs a lot of money. Depending on which property it is, you could depreciate it over 5 years. If you want to take that depreciation up front, you can. But in my opinion, when it comes down to certain things like a car a boat, a yacht, I would take that depreciation over a period of 5 years. Because if you take everything up front that first year, then that next year, that can actually reduce your tax liability. The next year you can't. Now let's just say the next year you owe the IRS maybe $5,000. You can't deduct that, because you did it the first year. So now you have to pay the IRS about $5,000. So that's where that depreciation come in over time. You got a question, ma'am?
Okay, I'll do one. If you open the office from your home, can you write that off? Like how do you write it off? Would it be for your homeowners? Would it be for business? How is it 2 different ways you can use it?
Well,
how does that work?
Depending on what entity you is, I'm just going to speak on a LLC sole proprietor type, because a lot of people, they don't have their business structure right. So I'm not going to dwell on S Corp or C Corp right now. So for your sole proprietor or your LLC business, most software, you don't have to do anything by hand. The software is going to ask you for the total square footage of the home. And then you're going to have the square footage of that particular area. So let's just say this from right here is my office space. I'm going to take this whole area and I'm going to plug the numbers into the software. And then that's how it's going to calculate a deduction for it. Okay. But you can't use that total space. That space must be used for business purposes only, nothing else. You can also take a portion of your phone bill, your light bill, if you're paying mortgage, paying rent, you can take a portion of that as well. You can't deduct half, and you cannot deduct the whole thing if you're working from home. Yes, ma'am.
The program you mentioned about the CD that you put into it every year. No? Yes.
Yes, ma'am. Okay.
My wife's.
Okay.
I've got 2 little ones at home, and she's all alone and overwhelmed. So I want to save mom real quick.
He's so good. He's so good. He called me. He said, "I'm gonna call you at 6:30." He called me at 6:30, and he has the baby with him. He's good.
Oh yeah.
I'm telling y'all, he's very good.
So good meeting y'all.
When it comes to business taxes, I recommend everybody get set up legally. Structure your business legally. Like I said, I was my own crutch because the tax money, Medicaid, food stamps, I was enjoying all of that. But I knew eventually I was going to have to get off anyway. But I hindered by, you hear something? Okay. So I was hindering myself. And there was so many different things that was out there. A lot of programs I didn't know about. I paid for a lot of things out of my own pocket. People wondering why you working like that? Why you working 2 or 3 jobs? Because I'm trying to fund my business. That's why. But if I would have known that all the programs, like for instance, the PPP, a lot of people applying for the PPP or the EIDL, they're using their name and their social security number. And opposed to if you had your business set up right, had your DUNS number, you have your EIN number, then you was able to put it in your business name. Another thing why you want to separate your business, your personal from your business, because let's just say somebody want to sue you for something and they go after, if they want to come after Kenyatta Walker, did you do business with Kenyatta Walker? I'm working for Walker's Tax Service. So technically you didn't do business with Kenyatta Walker. Kenyatta Walker just signed you up. You go after Walker's Tax Service. That's the business. Because if they try to sue you and your business not set up legally, they can't go after your LLC because there is none. They could try to go after your house, your car, something like that. It's called a separation of assets. So that's something to think about when it comes down to business. You want to start building business credit. So keep in mind, you need that EIN number. Register your business with the Secretary of State. Apply for a DUNS number. A DUNS number is free. Start with your Tier 1 account on Granger. That's one. Granger. Who else? Uline. You can use that, but they're going to want your DUNS number. And Dun & Bradstreet, that's free. Crown office supplies. I say so with tier one, they have some things that you don't really want, but you're gonna have to kind of settle for it until you build yourself up. If you're looking for funding for 100,000 or more, it's gonna take about a year to build it. When people say I could build your business credit profile in 90 days, I'm like, what in the world are they doing? It's something illegal. Now it's possible it could be done in 6 months, but to build your business credit, you need at least 3 or 4 accounts reported to the business credit report. You want to generate a Payday Score. A Payday Score is like a credit score for your personal credit. You want your Payday Score to be at 80. And the reason being is because when they pull that, you don't have to worry about touching your social security number. Now, in some cases, it's okay to touch your social security number for a personal guarantee. Like if you trying to secure a building that costs $100,000 or more and they need collateral, well, you know you're going to do what it takes because now you have this $100,000. You can use your social security number for collateral. So in some instances, it's just different. So those are some things that I just want to point out to y'all. If y'all need to look over your business filings, your business taxes, I can do that for you at no charge for you. But get your business set up straight. If you are self-employed and you're looking to buy a home, report your income so that you can get whatever you want. Once you get into that home, you can go back to doing whatever you was doing, however you was doing. But the key is to get to where you need to go. Now, you can also amend your taxes the prior year, but make sure before you apply for that home loan, you give the IRS enough time to update their systems. Right now, they are behind. They're behind millions of tax refunds right now. So those are some things to think about. You have any questions? Yes, ma'am.
For kids, for people just starting off with their business being self-employed, do you mentor them? Can you mentor them? Or?
Yes, definitely. So my y'all have all my information. Y'all can just give me a call to set up an appointment and we could set up a time. My time is kind of limited now because I'm back driving school buses. I take the latest appointment at 12:45, Monday through Friday, but I am flexible on weekends. Latest at 12:45. So if y'all don't have any other questions, I just want to say thank y'all so much for coming out. That means y'all dedicated. Y'all ready to take the next step forward. Take all of this information, write it down, do your research. I ain't gonna lie, Google can be your best friend. Seriously. When I go on the IRS website, sometimes it takes me forever to find something on irs.gov. And I like, you know what, let me just Google it. So thank y'all so much. I appreciate y'all. Did everybody fill out a piece of paper? I got 1, 2, 3, 4, 5. I got more than that. Oh, you filled out a piece of paper for you?
She wants some more to say. So tax school is still starting September 1st?
Yes, ma'am. And that's another thing. If y'all interested in starting a tax business, y'all do it. Don't think that this market is saturated because it's not. And with everything going on, tax law changes, COVID, it's good to have extra income. My first year doing taxes, I made $10,000 my first year. And I was happy about that $10,000. I said, you know what? The next year I'm gonna double it. And the next year I did what I had to do. Market. No matter what business you in, you're gonna have to get out there manually, door to door. It's COVID going on. If you just want to put the flyer in the door, that's fine. Go to the mall, type your business card on, take your business card on a windows. Those are the type of stuff that you're gonna have to do. Don't depend on social media because let me tell you, we don't own social media. Somebody else owns social media. You see how my space is gone? Facebook could be gone one time, any day now. You ever just wonder why you was logged out of Facebook and you have to log back in? We don't own those apps. Personal relationship is good. Talking to people, doing seminars, getting out there, marketing, network, offer a free product every now and then, do a raffle every now and then. Those are some good marketing. It works. It works because it helped me build my business, and that's how I'm able to meet a lot of different people. Everybody say no one? Oh, Lord.
So I definitely need to consultate.
Okay,
Because I need to be better than I did last year.
We definitely gonna work on it.
And I was in Alabama, I told you, I don't know if you remember, but I was in Alabama, so I'm home now, so I got an opportunity.
Oh, everybody, oh, y'all, let me get that announcement section of that.
Oh, okay.
No, just pick one. So, Miss Sandra, were you gonna be staying in Capitola?
Yeah, but I recognize it.
Okay. I'm gonna do something a little different. For those who are local, I'm gonna actually get out there and help y'all market.
So I got,
Ma'am? Yes, ma'am. I have a taxi.
so I'm in that new day.
Okay.
Well, actually, look like we 6 days. But I drive up every day. It's not, it wasn't important, girl.
Here, Wandrea. I cannot say your name right, girl. Here you go.
Oh, no.
You're welcome.
So I wanted to keep the rest of this part. Is it okay if I kind of like, oh, you have an extra one that I can just keep this here? Oh, I forget.
Yeah, all I need is the announcement report. You didn't get that announcement?
No, I wanted the rest.
Oh, yeah, that's for you. That's for you.
Okay. Where? So I'm gonna be breaking down. If you wanna stay and ask some more questions, you can.
And y'all have my card too. Y'all have any questions? I know, tell me. Call me and let me know.
You're welcome.